All right. Well, today I thought I would compare what admittedly is going to be a comparison of apples and oranges, but it's a kind of comparison that sometimes happens. And this comparison that I'm referring to is yield, which is the way we calculate the financial performance on a note, versus cap rate, which is the way we calculate what is the return on a real estate property that we're thinking about buying, for example, a multifamily home. So we see these two measures of financial performance, and they really can't be compared directly to each other, but let's just dig in and see what we can do. Okay, here we go. So the first thing that I think we need to do is define what we mean by a cap rate. And as you can see here, the cap rate is simply the net annual operating income divided by the property value, what we are being asked to pay for that particular investment. Okay, so that's the cap rate. And so let's take a look on LoopNet and see what's for sale. Here we are looking in Phoenix, Arizona, looking for multifamily properties, and we can see that there's one for sale. Natasha Alexander's got it for sale here. You can see this beautiful facility. It's 96% occupied, and we drill in a little bit more, and we can see that for a price of $155 million, we can enjoy a 3.33% cap rate on this property. Okay. So what then, therefore, must be the annual profit for this property? Well, we know that it's a 3.33% cap rate. We know that we have to pay $155 million for it. And so if we multiply 155 million times 3.33%, we would achieve, must be the case, that the net operating income on this complex is 5.161 million. So let's check. 5.150 million. Natasha, if it is 5.150 million, then in reality, the cap rate, my dear, is 3.323, not 3.33. Buyer beware. But anyway, that's how the cap rate is calculated. And so, with that as background, let's talk now about notes. And let's calculate some yields on some notes, shall we? So here we've got, the classic range of notes, maybe 6, 6.5, 7, 8, 9, 9.5, in that range. These are the typical yields on notes. So what must be, let's say if I've got a note that's, my investment is $100,000, you can see here. And I've got 120 months, you can see here, which is a 10-year note. And I've got a yield of 6%. What would be the equivalent cap rate for that? Let's find out. Okay, so what is my principal and interest payment in this case? Well, let's put it in here. Let's put it into the financial calculator. So I've got a present value of $100,000. And I've got a number of payments of 120. And I think we said 6%. So what would be that payment in that case? Oh, 11, 10, 21. Okay, 11, 10, 21. So the annual income on that, multiplied by 12, is 13,322, which is the number that we need for the cap rate. And so we can see that that cap rate, and the equivalent way of expressing it, would be 13.3, more than double what the yield calculation is. So it's kind of like, beware if you're comparing a cap rate to a yield, that they're completely different things, and that the number that you see on the page for the cap rate can be higher and a lot higher for exactly the same revenue coming in each month. So let's do 6.5. Let's change this to 6.5. And what's that payment? 1135.48. 1135.48. That's a 13.6% cap rate equivalent. And let's put in 7. 7. The payment would be 1161.08. And you can see 13.9. And indeed, if we were just to kind of fill it all in the rest of the way, you can see that on average, these different typical yields for notes from in the range of 6 to 9.5 correspond in terms of cap rates to numbers that are about twice as high if it was expressed as a cap rate. So that is a little bit of insight. Let's see that on a graph. Let's come back again to PowerPoint, and here we are. So here is 10 years of payments. Again, that we calculated from 6% to 9.5% yield expressed as a cap rate. And you can see that that cap rate, if it was expressed as a cap rate, is about double what the yield number would be. Bear in mind. Yield more conservative. And of course, this is on 10 years of payments. As the note extends in years, they begin to approach. Let's take a look at 30 years of payments. So here you can see that the cap rates, again, have a number that appears bigger for the same amount of revenue coming in each month. Because of the way it's calculated, it's a different thing. That's about, at this point, about 10% higher than what the yield would be reported on the note. Because the calculations are different, it's the same revenue coming in each month. So there, now you're aware. Now, so you can see the green bars, by the way, are the yield, and the blue bars, I think my picture is covering up that gloss there at the bottom. Okay, so now let's take a look at cap rates that are out there. So what I did is a search on LoopNet for multifamilies in Arizona. There are 2 that are for sale right now. You can see this beautiful apartment complex in Bisbee, 18-unit apartment building, and it's reporting. We haven't checked the math on them, but let's assume that they didn't make any mathematical errors. They're reporting a 6% basically cap rate, 5.97. And then there's another property there at 6.5. So that's what we're seeing in Arizona. If we, punch in, say, Texas, for example, the same search, we get, a number of properties. We can see here's one that's at 1.55%. It's actually kind of a little kind of spotty looking apartment complex in Austin at a 1.55. Indeed, to summarize, as you can see at the top of the screen, multifamily cap rates today are in the range of 1.5 to 6.5%. So that's what you can buy a multifamily property at, unless you're a really clever person. Now, if it's in the range of 1.5 to 6.5, and I just took a look at what is on Google right now, today itself, in regard to inflation rate, and you can see CNBC reported 2 days ago a big jump in consumer prices, 6.2%, Wall Street saying 6.2%, New York Times saying the fastest rate of inflation increase since 1990. Go figure, how could that be? So, do you see a kind of a little bit of a problem here? If we've got cap rates, if we're being asked to spend $155 million to get a cap rate of 3.3 and inflation is 6.2, does it seem like we're swimming upstream and the water flow is getting heavier and heavier against us? Especially since the highest cap rate we saw out there was about 6.5, which is more or less inflation as of this moment. Not so good. Now, let's take a view, a pretty interesting view of today's market cap rates that we saw in the range of 1.5 to 6.5, expressed as yield on a 10-year note. And you can see that every single one of those streams of payments that would have existed if expressed as a yield on a 10-year note would all have been negative. You would no way buy that note because a 1.5% cap rate equates to a negative 30.1% yield. You're losing money if that were the amount of money you were collecting on a note. And so you can see it's a completely different world. And so now let's talk about apples and oranges a little bit again. Because in fairness, I said at the beginning, and I should repeat again now, yield is one kind of a calculation, cap rate is another kind of a calculation. They're for different things. And let's talk about what's really different here, and this is probably the most important one. In fairness, when we talk about the payments we receive on this apple, this note, as a yield, we're talking about principal and interest coming back to us. Not just the profit, but our own money coming back to us as well. Whereas when we talk about a cap rate, we're talking about the profit only. Okay, fair, noted. And some other points to be made about that property that we might have bought for $155 million. Perhaps over time, if things go well, it will have capital appreciation. We may have tax benefits when we depreciate. Yes, that's true. On the other side of the coin, it can be granted in regard to the note that getting my principal back is, after all, a good thing. You know, we're investors, and we have if we're a grocery store, what we do is we put cereal on one aisle, and we put laundry detergent on another aisle, and we put fresh produce on the other aisle. And one of the key things that makes our grocery store profitable is the velocity of turns of all of that product on the shelves. So if I have a slightly lower margin, but I turn it many more times, that's better than having a slightly higher margin and turning it only once. So the same thing is true with money. Money is my groceries inside of my grocery store as an investor. So if I get that principal back every month, I can reinvest that. Now, if I've got capital appreciation on that multifamily, let's say it's gone up in value over the years, I can also pull some of that equity out, can I not, by doing a cash out refi. But the difference is I have to pay interest in that case. In order to get access to that money, I have to pay interest to someone like you and me who own a note. So it's expensive to get that money back out again. And of course, the last thing that we note is that in regard to a note, often we invest that money in a tax-free account. So then I already have the tax benefits. So now let's take one last slide here and unpack. Granted, okay, we've granted all these things. We've granted that they're two completely different measures. They're two completely different assets. The numbers cannot really be compared one to the other. Granted, all noted. Anyway, for fun, now let's just take a look at what this looks like. What are we looking at here? So what we're looking at here is the Apple here, the note. It's a 10-year note and a cap rate. What would be the equivalent of 0% return on a 10-year note if it was expressed as a cap rate? And the answer is 10%. A 10% cap rate, those payments coming in each month equate to 0 return on a 10-year note. And on a 5-year note, it would be a 5% cap rate and so forth. And so we slide over here to sort of the low end of the range on notes, a 6% note there on the right. And what would be the equivalent for those payments that are coming in, which are not exactly comparable as we've already noted and granted, but what would be the equivalent of those payments coming in expressed as a cap rate? 13.3. You'd have to find an investment, real estate investment, that advertised itself correctly as a 13.3% cap rate to equal that same stream of income that you would get from a 6% note that had a 10-year term. So that's interesting. I hope you found that interesting. Kind of a quick review of how cap rate is calculated and a sort of unorthodox comparison of those two measures of financial performance. All right, I'll talk to you later. Bye for now.